Okay, welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I hope everyone had a great holiday weekend. Coming back to the markets, things are a little bit more stretched than what we talked about last week with respect to markets reaching all-time highs and finding a little bit of complacency in the markets. So we're seeing a lot of that still happening today. So we want to address that, see where some of the indicators currently look, and get a better sense for what our views are going forward. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Could everyone please hear me? If you can, please type yes into the chat window here. Okay, perfect. So as we normally do, what we're going to discuss here today is we're going to start off with the equity indices. Like I said, things are largely the same as when we spoke last week. They're just a little bit more stretched than what we saw last week in terms of complacency, in terms of reaching overbought conditions. And what we'll do is also take a look at the fixed income markets and seeing how the fixed income markets have reacted to economic indicators. So some of the things we discussed last week was that one of the ways to tell whether the debate was as to whether inflation is more transitory or permanent. We're going to see that debate play out using interest rates. And the interest rates have spoken a little bit over the past week or so, and we want to talk a little bit about what they look like and some of the economic indicators that pushed the indicators to move, push interest rates lower, and what the ramifications that has been for equities. Then we'll take a look at some of the commodities, because I do think the other half of the picture here, especially with respect to raw material pricing, is still important to look at, and they are starting to move. So we want to take a look at how they're currently reacting to the markets. And then taking a look at sector rotation, which sectors are strengthening, which sectors are weakening, and what we're currently seeing there, before showing you some of the economic indicators that I was referring to that have driven interest rates lower here over the past couple of days, and then share with you some of our ideas for today. But the primary question that I want to help investors answer during today's session, which is something that we continue to receive over the past week or so, is really, are we starting to reach a level of complacency that suggests that equity markets are ready for a pullback? That seems to be the primary question that most investors are currently asking. So my name is Tony Zhang. I'm the chief strategist here at Options Play. And I want to share with you my technical research, the charts that I'm currently looking at to help evaluate that very question and how I'm trying to answer that question, and sharing with you some of the ideas that we currently see here in the broader markets. So if we start off with the S&P 500, the weekly chart, very clear uptrend here on the weekly chart. The daily chart, as you can see, we're starting to reach overbought conditions. We've made a new higher high, multiple higher highs day after day. And if you could look at the daily RSI, it's starting to reach that overbought condition. So just on a momentum basis, we are certainly reaching that overbought condition, which certainly leads to the conditions that, suggest that there could be a potential pullback. But more importantly, this is not the optimal time to be adding new long positions when markets are new all-time highs. You want to look for stocks, if you are looking for stocks to add long positions, and look for stocks that have been oversold, look for stocks that have a bounce opportunity, or look for short candidates potentially in this type of market condition. But there's no doubt that the markets are in a bullish trend. So this is still the type of environment where you want to be selective in finding bullish opportunities, but also at the same time tactically looking potentially for some hedging opportunities, and also potentially some bearish opportunities are suitable. Now, like I said, the NASDAQ 100 largely has reacted on Friday to the jobs report. Relatively strong jobs report, interest rates fell, higher beta names like the QQQ and ARK and some of the higher beta tech names have performed well during that. So QQQ, very strong move here to the upside above its all-time highs around $340, continues to move higher here, also reached overbought conditions, and did manage to confirm or break out from what has been a long multi-year negative divergence we've seen on momentum, which means that we make higher high on price, but momentum fails to make new highs. But as you can see, last week we started to break out to new highs, and momentum also made a new high. So this is, I would say, an encouraging time for higher beta tech names at the moment, and that's where some of the opportunities investors currently see. When we look at small caps, this is really what, part of the concern that a lot of investors have with trading equities right now, is the fact that you don't have broad participation in these rallies. The S&P 500 made a brand new high. The QQQ made a brand new high, but the Dow has failed to make a new high. Dow transports have failed to make a new high. Small caps have failed to make a new high. Small caps hasn't made a new high since March. This is concerning for most equity investors, because for a healthy market rally, you need to see all of the indices continue to confirm these new highs. We're not seeing it on small caps, and we're not seeing it in RSP, which is the equal weight S&P 500 index, as you can see, still at the highs that we saw here in early May. And what this tells us is that most of the names in the S&P 500 are not making new highs. What you have is a few big mega cap names dragging the markets higher, and that's not particularly healthy for a market rally. You don't want to see that. That's what we saw in January and February of 2020 before the coronavirus sell-off. That's what we're seeing right now. And just to be clear, those conditions do not in itself lead to a spectacular sell-off. You still need an outside catalyst event in order to trigger that. We're not there yet, but we are certainly setting up the conditions that could lead to a somewhat spectacular sell-off here. Another further evidence of this market breadth that's extremely weak and quite concerning for me is the fact that the percentage of stocks in the market that are above its 50-day moving average is only at 50%. That's very unhealthy for a market that's at all-time highs. When the market's at all-time highs, you should see 70, 80, 90% of the stocks above its 50-day moving average. When you have such small participation in stocks above its 50-day moving average, this is showing you that market breadth is extremely weak. Now, weak market breadth can continue to move on for weeks, sometimes even months, right? So that in itself is not a good reason to go out there and short the markets. But it is time, because as volatility moves to pre-pandemic lows, we are talking about a condition where it is relatively inexpensive to buy a put hedge. You can buy a QQQ or SPY put hedge for somewhere around the 1% to 2% range of your portfolio size. And when volatility is this cheap and there's so much complacency in the market, the conditions are right to start looking for potentially some put hedges for your portfolio. And then when we look at the interest rates, what has driven the markets higher here? And I would say largely it has been the move we've seen in the 10-year. The 10-year reacting relatively strongly to the job reports last week, which we'll take a look at in our economic indicator section. But like I said, we look at these economic indicators to help us inform our decisions as to whether inflation is more transitory inflation. And for those of you that feel that you don't want to, or maybe you don't feel capable of reading these economic indicators to help answer that question, one of the things that you can do is you can look at interest rates. The interest rates are effectively the market's debate of whether this inflationary concern is going to be more transitory or permanent. And the reaction from fixed income markets, as bonds were bid up last week and yields have fallen, this is the bond market or the fixed income markets effectively saying that the inflationary concerns are more transitory from the jobs report. So you now have the 10-year yield down to about 140 basis points. This has caused the equity valuations to continue to expand. We're seeing some of the higher beta names expand in terms of multiples. That's why we've seen the QQQ and the tech names within the S&P 500 continue to respond well to the current market conditions. And that's why we have the market conditions that we have right here, is this interest rate move that has somewhat settled the debate a little bit as far as the inflationary concerns. However, I do want to point out that if you look at the commodities, especially the inputs for some of the consumer goods that we need to purchase, that is the second half of the equation with respect to inflation. things are not all well on that front. You have commodities continuing to rally. Crude jumped this morning on the OPEC meeting that have failed to reach an agreement of price increase in terms of production. We had a pretty sizable move here in crude back up to about $76. And this really starts to test what has been a major resistance level going back to 2018 or so, the $76 high that we've seen. And if we break back above this level around 76 or so, you're targeting about 90 to 110 here to the upside. I mean, when you asked most investors when oil was at $40 for quite some time, whether they'd ever see $100 oil again, especially in 2021, I think most investors would have said no way in hell. So, but we are starting to set up the conditions where we could see $100 oil again. And especially for those of you looking at energy as a sector, you know, that would certainly be a tailwind for energy as a sector. But failed OPEC meeting, starting to see crude continuing to move higher. But this is across the board. Gold bouncing off of $166, or rather GLD bouncing off of $166, which was the support level prior to this sell-off we saw here during the early days of 2021. Broke back above that level, rallied all the way up to about that 180 level and fell back down to 166, but so far holding this 166 support level here for gold. If you look at the long-term chart here for gold, this almost starts to look like a bit of a bottoming formation. You might call it an inverted head and shoulders. You can call it quite a few other different patterns here, but this could set up for a fairly bullish play here for gold all the way up to the 192, 195 area. So, you know, we're seeing this type of move not only in crude, which has, you know, some influences, if you will, based on producers and OPEC. But gold, you have the same thing. We're also seeing it in copper, some of the raw material commodities that go into the consumer goods, finding support here at the 200-day moving average in terms of copper breaking out above the 21-day moving average after what has been a fairly sizable correction here after a big move from about $2 to about $5 in copper. We've corrected back down to about 4 and an eighth, and if you will, and now breaking back above the 21-day moving average. So potentially also seeing copper continuing to move higher here, back into the high fours, if you will, for copper. So, you know, we're seeing commodities move across the board here. It's not just, you know, one or two commodities, and that's the other half of the inflationary picture as to what's going to drive inflation with respect to consumer goods. And it's mostly a lot of these raw material prices. And these are some of the things we're starting to see increase. So that might drag inflation numbers back higher here, even if labor starts to offset some of that at the moment. So looking at the sector rotation model, this is really where we start to see some movement here over the past week or so. We haven't seen any movement in terms of relative strength because most of the movement has been upwards or downwards, which is only in terms of momentum. Left and right is when we start to see some changes in relative strength. And the only one that has really changed in relative strength here is real estate. Otherwise, consumer staples, industrials, financials, and materials starting to see some improving momentum. At the flip side, technology, discretionary, and healthcare starting to see some loss in terms of momentum. Energy also seeing some strength in terms of momentum, but no one's really gaining or losing any relative strength here. So this is one that we continue to watch here. Like I said, this is the type of market that concerns me because what you might see is some of these just start to fail again, meaning lose some of this momentum. Technology and discretionary start to gain some momentum. If we start to see this reverse, this is what we fear the most because when you have only a few leading sectors continuing to lead for quite some time, and you have the rest of the sectors either lagging or weakening, that is unhealthy for a market. And we've seen that for about almost 4 weeks now. The longer this goes on for, the more unhealthy this market is. And especially when you combine it with the complacency indicators that we've talked about earlier, when you combine it with the lack of market breadth on these rallies higher, these are all the conditions that we saw in January and February before the coronavirus sell-off, meaning unhealthy markets where a catalyst event or an external catalyst event drives a lot of excess volatility to the downside. So the longer this goes on for, the more, the bigger the potential of a sizable violent sell-off that we could see. Right now, I wouldn't say that we're in this for very long. I would say we're in a kind of a medium amount of complacency and narrowness of breath. We certainly have seen markets that have stretched even further than this by about a month or two. Like I said, we started talking about some of these things in December of 2019, and it lasted until basically mid-February before the coronavirus was that external catalyst that drove that external volatility. What will drive the volatility going forward? I don't know. Obviously, the Fed is certainly one possible external factor, but maybe other things that we simply cannot predict at the moment. But we are certainly setting up the market conditions that could lead to sizable sell-off. So these are some of the things that you really have to be careful as you take a look at equity investments at the moment. There's not enough of a reason right now to say go out there and short the markets, but I do think there's enough of a reason to start thinking about preparing for a put hedge, whether that's selling some cover calls and collecting some premium, potentially buying some cheap hedges, but not putting on a full hedge just yet. I don't think it's time for that. You need some external factors. You need a catalyst before you put on that full hedge, but it is time to start thinking about this, start preparing for it. And if you're not familiar with how to hedge a portfolio, start learning about it. These are the times that you need to get ready for those things. And then once you are at the point where the market external factors come in, that's when you want to pull the trigger on those hedges. So looking at some of these sectors here, we see technology breaking out to new all-time highs here on Friday's move. We're going to see likely a continuation. I'm sorry, this was discretionary. We saw discretionary manage to break out to new all-time highs here. But as you can see, the RSI on both the daily and the weekly chart is starting to get overbought. So you have similar conditions here in discretionary as you do in technology, where both sectors have reached new all-time highs, but has reached overbought conditions on both the daily and weekly charts. Technology is overbought on daily and weekly charts. So, and just, if you draw simple channels like this, right, we're clearly at the top of the channel. As you can see, every time we reach the top of the channel, these have been times not to add to long positions, but look for a pullback. And on those pullbacks are your opportunities to look for those long positions. So just be aware of where we are within the market cycle. We are near the top of that cycle. But just because we're at the top of the cycle doesn't mean that markets can't continue to move higher. We have seen many, many instances and many conditions where this actually gets a little more stretched before the rubber band breaks, if you will. But those are some of the conditions that we really want to be aware of. On the flip side, I do think that if you're looking for long opportunities in this market, you see that the markets are moving higher, you don't want to miss out on it. You look for weaker sectors that are starting to strengthen again here. So you have industrials that have really moved sideways and moved actually a little bit lower over the past few weeks as the markets rose, losing that relative strength, but is now starting to gain some of that back. You have both industrials and financials in that quadrant, if you will, that have now broken back above the 21-day moving average and potentially is continuing to move higher again. So again, in that market cycle, you don't want to buy sectors that are near the top. You want to buy sectors that perhaps have corrected and have now started to move back up. And industrials and financials certainly fit that bill at the moment. So as you're looking for opportunities, be more selective from that perspective. And that's really what sector rotation gives you a better sense for. Now, when we look at the economic numbers, this is really what drove interest rates lower last week. It was non-farm payroll. We were expecting about 720,000 jobs added, but they came in at about 850,000, a little higher than expected. It's certainly a big correction from what was a really weak number here in April. May looked strong, June looking very strong here so far. And this helps settle the half of the debate with respect to inflation on the wage side. As As people start getting back to work, especially as unemployment benefits start to taper off across, at least the federal unemployment starts to taper off, we're seeing strong job numbers. And this is specifically driven by leisure and hospitality, as well as state and local, in terms of where we're seeing the gains here. And this is all conducive for the labor shortages that have caused the wage inflation. The more people get back to work, the more that's going to ease. And this is what drove interest rates lower. That's what drove equities higher here. So it's important to pay attention to this. But I do want to balance that picture here, what looks like a strong economic recovery from an employment perspective, which is good. And that also that also starts to think about, whether the Fed's going to move or not, or how they're going to move, and the markets have reacted to that as well. But on the other side, when we talk about consumer goods and we talk about inflation from a more, I would say, traditional sense, meaning the cost of goods that you need to purchase, this is really where the picture is still fairly concerning on the other side of the equation, because employment in manufacturing have now contracted to below 50, which means that we're back in contraction territory. This was the territory that we saw during the coronavirus. And this is partially due to the fact that factories simply cannot find enough workers. They can't find enough people to hire. So they've actually seen a contraction in terms of employment. That's not particularly good. Also, the prices paid for raw materials that go into the goods that they produce continue to rise. This is the commodities that I was showing you before. I just showed you a sliver of the commodities that are important here. But overall, the economic picture from a manufacturing perspective is not strong. It's actually weakening here. And those are some of the concerns that I see that really we need to balance that with the strong employment numbers that we currently see. So I think that the picture, in my opinion, is a bit more mixed and a little bit more nuanced. And I think that if you look at the interest rates, trading at about 140 basis points, we might start to get to near the bottom of that. We might start to see interest rates move a little bit higher, especially as employment gains perhaps starts to decelerate a little bit going the next couple of months. So these are some of the things that we are continuing to pay attention to. But again, the interest rate number is really the market's indicator, if you will, of this current debate. So looking at some opportunities here in this market, like I said, what you want to do is, if you're looking for bullish opportunities, you really have to be selective, not only in terms of sectors, but also within specific stocks of those sectors. So one particular name that stood out to me is Mohawk. And Mohawk is a relatively small cap name from the perspective of, it's in the home builders ETF or home builders index, but it's not a name that most of us think about. They're a primary manufacturer of flooring and carpeting, but this is the type of name and the sector that has been quite strong, but has seen some weakness here over the past few weeks, and that is the opportunity that I see. You have a very strong uptrend here, and after a big move to the downside, a big correction, we've now started to see it continue that move higher here. Mohawk breaking back above both the 21-day and the 200-day moving average, in my opinion, sets it up potentially to revisit those all-time highs around 230. Strong fundamentals for a company in the home builders index, and this recent pullback here, I think, is the opportunity. So especially when you're looking for long opportunities, look for stocks and sectors that are oversold, that are still bullish. Those are the ones that have a higher opportunity of continuing to move higher, especially as markets are near all-time highs. Versus buying a stock that's at all-time highs, you have a much higher risk of a potential pullback. So for example, if I bought Mohawk on this move higher here, I have that risk of that pullback. But if I wait for that pullback and I look for that potential opportunity higher here, then I have a better risk to reward ratio of a continuation higher here. So you have to be really careful with names like that. The second sector, if you will, that I want to pay attention to here are the airlines. The airlines remains extremely strong in terms of the numbers that we're seeing. Air travel has actually come back substantially stronger than many investors had predicted, or even the airlines have predicted. Delta Airlines trading near a bottom here around 44 or so, which has been a resistance level here from late last year. Near the bottom of this channel, looking for a bounce up to 48, potentially up to 52 to the upside in the longer run. This is the opportunity that I see here in a name like Delta Airlines, one of the stronger U.S. legacy carriers, and from a financial picture perspective and also from a numbers perspective, looking for that opportunity. Basically seeing the stock is trading in a range, near the bottom of the range, looking for a bounce higher in an industry that we're fairly confident in. And then on the flip side, look for weaker stocks that are no longer continuing to outperform here, especially within the travel industry. We're seeing travel bounce higher. We're seeing most travel stocks trade higher here. But if you look at stocks like Airbnb, it continues to weaken here ever since that IPO, and it traded above this 170, 210 area or so. It's failed to break out above that level, came crashing down to 130, has managed to rally back up to 150 or so, but it continues to lose momentum here. And this is the one that I see for potential some further downside. Airbnb, unfortunately, as strong of a company as it is, trades at an extremely rich multiple, and that's what's concerning to me here. And the technicals don't look particularly strong. The relative strength, the momentum, excuse me, look fairly weak here, and the technicals, unfortunately, in my opinion, favor further downside. So as you look for potential correction opportunities, these higher beta, excuse me, these higher multiple names, these are the ones that I think have potential opportunities here to the downside. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of the broader markets, how I'm viewing this complacency concerns that a lot of investors have, how I'm positioning for that, and really how I still seek opportunities in this market that is near these extremes. With that, thank you so much. I hope you guys find this useful for you, and I will see you guys here next Tuesday. Actually, we do have an options education session tomorrow afternoon at 4:15 p.m., and I hope to see some of you there. We're doing another basics on options course starting tomorrow, so I hope to see many of you there. Thank you so much, and have a great trading day.